We're absolutely delighted to have Tim McElvaine here with us today. He's the founder and president of McElvaine Investment Management. He developed his value-oriented philosophy during his 12-year career with Peter Cundall and Associates, where, amongst other capacities, he served as manager of the Cundall Security Fund, co-manager of the Cundall Value Fund, and chief investment officer. He had previously earned a bachelor's from Queen's. After working at Touche Ross in Toronto, he joined the Bank of N.T. Butterfield in Bermuda. He moved to Vancouver to join Peter Cundall's firm in 1991. He has served on the board of directors of several publicly listed companies, including Sunripe Products, Humpty Dumpty Snack Foods, Rainmaker Entertainment, Glacier Media, WeCommerce Holdings, and Bastion Square Partners. Thank you for joining us today, Mr. McElvaine.
Oh, my pleasure, Itai. Thanks for inviting me.
Excellent. So let's get started with the presentation.
Yeah, sure. I just thought maybe one of the interesting things to do first would be for me to share a little bit of a framework. So let me just get started here. Great. So I wanted to kind of give you some context to think about value investing. So I call it value investing without Pepto-Bismol. And although we're not going to talk about any companies, I have my inexpensive legal disclaimer. So I thought, like Charlie Munger says, the best way to start thinking about something is to invert it. So let's think, if you didn't want to be a value investor, what would you do? So I thought, well, one of the things you might do is buy from thoughtful, smart investors. So for example, when a company does an IPO, the seller thinks about the price, the investment banker thinks about the price, everyone's thinking about the price. So that would be an example, I think, of how not to be a value investor. Hope that the share price you're paying is okay without thinking about any type of intrinsic value. Ignore the balance sheet of the company, meaning you're not worried about its staying power. And then finally, in my mind, don't worry about whether or not the insiders own shares, whether or not they have a prison record. Basically, don't worry about the alignment of interests. So that's kind of some examples about how not to be a value investor. So flipping it around the other way. So I was kind of thinking about what are the key elements? So the first concept is this idea of intrinsic value. And I kind of like to think of Mr. Spock, this cold calculating determination of what intrinsic value is. And then you compare this to the market price, which is, of course, more like Homer Simpson. It goes all over the place relative to the intrinsic value. Now, as a value investor, we're interested in this little area underneath called the margin of safety. So, when we approach investing, we really think about three things: what's its worth, what's the risk, and what's the insider's focus. So I just want to spend a second on that, and then we'll turn it over to your Q&A. So I call it ABBA. I like the acronym. So the first question, the first A is the accident that has given us the competitive advantage, so to speak, to invest. And I'll come back to that in a second. The second is the bird in hand or bird in the bush, however you want to call it. And the price that you're paying that gives us the margin of safety. And, I just talked about that with Mr. Spock and Homer Simpson. The third thing is, I call it brick house, meaning the second B, but it's staying power, financial capacity, positioning of the business, free cash flow. And the reason I call it brick house a little bit is if you think about that story, Three Little Pigs. You had the pig who was in the straw hut, and you had the pig in the stick hut, and then you had the pig in the brick house. Well, investing, a wolf's always going to come to the door sometime when you own a stock. So you want to make sure you're in the brick house, so you have staying power. And then the last thing, the last A in my ABBA criteria is what I call alignment of interests, incentives and ownership. As you mentioned, I've been on, I think, 6 public company boards, and that's probably the most important thing a board does is dealing with the incentives and then the capital allocation. So I want to come back to this for a second. So where do you find value? Of course, as Charlie Munger says, you have to fish where the fish are. But I call it accidents, but what I really mean is I'm looking for dislocation. Now, Webster Dictionary says dislocation is disruption of established order. But what I say it is where a seller doesn't care about the price. So think about that for a sec. So you're buying from a seller who doesn't care what price he's getting. You think, well, why would that happen? Funny enough, it happens more than you think. And here are some examples. For example, of course, a spin-off, emergence from bankruptcy, or the removal of an index, or an unpopular area such as a country or an industry. You know, bad news, an earnings miss, a dividend cut, people just sell. And then there's underfollowed securities. To give you some real examples, so in the spin-off side, last fall, there was a company called Jackson Financial that was spun out of Prudential PLC. And the interesting thing here was Prudential is primarily UK shareholders. So they set up a facility to allow UK shareholders to sell their Jackson Financial shares. So they didn't care what price they got. They just wanted to sell. So that's the example of a dislocation where the seller doesn't care about price. Idea of an unpopular area, of course, was oil and gas in the middle of 2020 when oil price went negative. People just didn't want any part of oil and gas ownership. And then there's bad news and dividend cuts. You know, there's no shortage of those from time to time. So when I toss it back to you guys, when you're thinking about your framework, as you're developing your framework as you go on, these are the 4 things I suggest you think about. First, what's my competitive advantage on the purchase? And meaning, how do you make sure you're the thinking investor and dealing with someone who isn't really thinking about the price? I kind of joke a little bit. It's like if I was going to box, I wouldn't get into the ring against Muhammad Ali. You know, I'd try and get into the ring against someone I was sure I could at least not get knocked out by. So before you step into the ring of investing, so to speak, make sure you have a competitive advantage on the purchase. I know Charlie Munger and others call it circle of competence, but I'm changing that a little bit because what I'm looking for, as I said, is dislocation. And I will enough on that. Margin of safety, we talked about that a little bit before. It's the idea that if you have a 1-ton vehicle and you're going across a bridge, you don't want the bridge to have capacity of 1.1 tons. You want to have like a 5-ton capacity. So the bigger your margin of safety, the better off you are. Does the company have staying power? We talked about that. And then the motivations and incentives of the board and management. And you might spend a little bit of time thinking about this because I think it's extremely important. And certainly in my best situations aren't that the board and management did something amazing, but rather the company got into difficulty and they were rational and they operated in a fashion that was fair to all shareholders. So that's kind of what I look like. Are they in the same boat as you are? And I think I've rambled enough, Itai. So that's kind of all I wanted to say. I will stop sharing my screen and turn it back to you.
Yeah, sounds great. Thank you for that presentation. Can you speak a little bit about how did you initially become interested in investing and in value investing?
Well, I was a CA or CPA and working in Bermuda, and I'd always, I guess, had an interest. Well, let me go back a step. When I was a teenager, we lived on a small farm. My dad set me up in the chicken business. So, you know, he bought me the chickens and the hard assets, the fence, but I had to make a living, so to speak, from collecting the eggs and selling them to our neighbors. That's a tough business. You know, I think it was my first insolvency. I went under. We had to liquidate the chickens, which meant they became a stew. And I vowed after that not to go into the agricultural business. So somehow that I made my way into the investment business. When I was in Bermuda, I wanted to come back to Canada, and I knew how I thought about investing and just tried to figure out the investors I thought could make me a better investor and I could mentor from. And certainly Peter Cundall was at the top of the list. At the time, we of course had fax machines. So I think Peter either had to change his fax number or hire me by the end of the day, because I hounded him, but thankfully he hired me.
Yeah, can you speak more about that relationship with him? I mean, maybe some of the key lessons that you learned from him.
Oh yeah, Peter was great to work for. I worked with him for about 12 years, and then I went off on my own, primarily because I went through a divorce and had some young kids, so I wanted to spend a little bit more time with them. Peter remained my largest client until his passing in 2011, and I'd go over and see him. So he was a phenomenal person to be around. I enjoyed him a lot. The key things I think he talked about was one, the importance of simplicity, like you know, a little bit of the 80-20 rule, that there becomes a point in time when the only research you're doing is really to make you feel better about the idea. So you're really getting stuck in confirmation bias. So there's a point in time where you know enough, and the important thing is, do you know the right things? If you, like, as I used to say to the analysts who work there, anyone can give you 10 reasons to buy a stock. You want the 2 or 3 most important ones, and what could go wrong with those. And the second thing about Peter was, well, he had patience, but he also had a lot of fortitude to go against the crowd. So both those things were simplify and fortitude were important things for me to learn.
Yeah, that makes a lot of sense. And can you speak about some of the challenges when you did start your own fund, and maybe the advice for students who maybe dream to start their own fund?
Well, you know, the toughest thing about starting your own fund is, of course, getting someone to invest in it. It's so I've always been a little bit of a lousy marketer. You know, that's one of the things. Interestingly enough, the people who encouraged me the most to set up my own fund didn't necessarily invest. It was more the people who said, "Oh, that's interesting. Keep me on your radar screen." So when you make up your list of people who you think would invest with you, if someone just looks, sounds kind of interested, don't drop that ball, because they may end up being your best supporters. And of course, word of mouth is great. The compliance hurdles are much higher than when I started. So, but I don't know, does that answer your question, Itai? I don't know if
Yeah, I'm curious about the compliance hurdles as well. How do you think they're higher? Is it just more expensive now, sort of the run rate for the fund, or what are your thoughts on that?
Yeah, perhaps the amount of time you spend on compliance, certainly up here in Canada, is a lot more. I run, or my fund is a mutual fund, so there's no shortage of things we have to do around that. And certainly it's a lot more than it used to be. But you know, if you're honest and fair in your dealings, that takes care of most of the problems right there.
Yeah, absolutely. And you spoke a little bit about, you know, how you saw oil, I guess, in during the pandemic, and that sort of contrarian view. Oil is in a very different situation now. How do you see oil today and the energy sector to invest in?
Yeah, it's a toughie. I'm not really much of a macro guy, but in 2020, we acquired a position in 3 companies. Really 4. One of them we got into because we owned the debt, which was being converted to equity through a Chapter 11. But there was one natural gas producer, one royalty company, and one oil and gas producer. The important thing was, you could get an idea of what the reserves in the ground were worth. So PDP, producing and developed reserves. And my focus was to try and buy the company for less than that. And that's kind of what we did. I also kind of overlaid it with wanting to have a company that had a competitive advantage. So we continue to have 2 oil and gas positions we've trimmed. One of them's Tourmaline Oil, which is really a gas company, Canada's largest gas company, but it's more like a manufacturer in many ways because it has a very long reserve life, has very low development costs, and it has a very unique and diversified selling strategy. So it's kind of a rinse and repeat a little bit on the cycle. And then the other one is Prairie Sky Royalty, which is Canada's largest freehold royalty company, which is once again a little bit of a unique asset. So I tried to deal with the value pricing, but overlay it with some type of moat to the extent that you can get a moat in the oil and gas business. As I said, we've trimmed both of those. We continue to have smaller positions in each. I'm not sure what happens in the future if you know. Sorry, I can't help you with that. Do you know? If you know, tell me, please.
And I just want to ask a little more about your criteria for looking at these oil and gas companies. Are they all ones where they already have everything in place, or do you look at development and appraisal companies at all? And also, is it companies exclusively in, let's say, more safer countries like Canada and the US, or do you look at companies at all that are operating in third world countries?
Well, first of all, I rarely do anything in the metal and mineral oil and gas area. It was just a brief moment in time that this was interesting. The second thing, if I was going to do it, I'm kind of a belt and suspenders type of guy. I wanted to, even if I left money on the table because other ones had more torque, I wanted to make sure our downside was protected. So yes, I wanted to stay within North America, and two, I wanted companies that had proven reserves. I didn't want any type of development company. So, you know, today there are a lot of people talking about the oil and gas stocks. I have zero interest. I really spend zero time on it. Not because I don't know if they're cheap or not, but it's just not. I don't have a competitive advantage at today's prices. I did in June 2020. I don't today. So I'll leave it for someone else.
Yeah, I think that makes sense. I want to speak about, so you have something that's pretty unique, which is you have Itai Holdings as one of your holding companies, and that is a private company. So can you speak a little bit about how you acquired that position?
Yeah, sure. Itai is a insurance company, really controlled, nearly majority, well, by far majority owned by Francis Chu, a value investor up here. It was actually purchased, the underlying workers' comp business was actually purchased from Monish Pabrai by Francis. So when Francis purchased it, he phoned me up and said, was I interested in investing? And I said, I don't do anything personally, Francis, or I try not to. I try and do it through the fund. So if you're okay with my fund investing rather than me personally, then I'd be interested. About a month or two later, Francis phoned me back and said, sure, you can go ahead with your fund if you'd like. So that's how we ended up with it. You know, I have a lot of both Monish and Francis. I have a lot of respect for both of them. I've known both of them a long time, and I thought it was a unique asset with a value investor who I know well, and you know, Francis was there at the beginning of Fairfax Financial, and has a long and deep understanding of the insurance business, and I trust him implicitly. So I was pleased to be able to invest. It was nice of Francis to offer it.
Yeah, absolutely. That makes a lot of sense. You have some holdings, from my understanding, in China and Hong Kong. What is your framework for investing in China and Hong Kong, and how do you sort of get past some of the political risks there?
Oh, it's a good question. The company that we have is called CK Hutchinson, which is a chicken's way to invest in China a little bit. You know, I took a look at Alibaba and some others, and my mind's not made up. Obviously, the price is attractive. The case of CK Hutchinson, it's really a worldwide conglomerate. Its largest business, in fact, is a telecommunications business with a large presence in Europe. So you're getting a lot of pieces there. We paid a little bit less than where it's trading now. And at the time we purchased it, and I still think today, I figured it's worth between 2 and 3 times more than we paid. The question people will say, and it's a single digit PE and 4 or 5% yield. You know, Li Ka-shing's son runs it now, so family controlled. The knock on it, of course, people will say is it doesn't, it's always traded at a discount, and why would that change? From my point of view, it's cheap. The businesses are unique and very strong. They have one of the largest port businesses in the world. They have a very large telecommunications business, and they have a very large health and beauty retail business in there. And then they have an infrastructure business, which isn't quite as big a piece. But I just think it's a unique collection of assets controlled by honest, thoughtful owners, trading very cheaply. When will it go up? I don't know. That's but I got my downside protected, and I got a margin of safety, and they're the things I focus on.
Yeah, absolutely. And you spoke previously about Jackson Financial. We actually had another speaker speak about that. That was a really interesting investment. How big of first, that was a spinoff. How big a part of your portfolio is spinoffs and other special situations?
Well, it depends. It depends on what's available. Right now it's relatively small, but there's a fair amount of stuff in the hopper. So, you know, things that people can kind of keep an eye on, from super big companies like GE Financial, all the way down to smaller companies like Colfax or Zimmer V got spun out of Zimmer just recently. So there's a whole bunch of different things to look at. The thing is just to pick your spots and your prices as far as when you participate. So if you're thinking about doing spin-offs, I'd say the calendar looks pretty good, but we don't have a lot there right at the moment.
Yeah, that makes sense. And how useful do you find screeners, both quantitative screeners and keyword screeners, in your investment process?
Well, you know, I'm kind of small, so I don't need to find a lot, and we don't own many holdings. I think right now we have 14 holdings, and really 12 of them are, 2 of them aren't very large, so really 12 holdings. We usually go between 10 and 20 holdings, so I don't do that much, so I don't need to screen a lot. Screening can kind of be difficult in that it can throw up on good ideas, but you find a lot of junk, so you waste a lot of time. What I like to look for is situations where something seems to have gone wrong. So if there's an index deletion, I'll take a quick look to see if there's anything there. Spin-offs we talked about. If there's an earnings miss, something like that, I'll take a look. But what I really like to do, of course, is if there's an area that's out of favor, then I'm quite interested in looking there.
Yeah, absolutely. And we previously spoke about China and Hong Kong. Let's speak now maybe a little bit about Japan. Japan's a market where you have a lot of things that look very quantitatively cheap, but a lot of them have, you know, been value traps historically. How do you sort of avoid these value traps in Japan when you're investing there?
Well, we actually don't have anything right in Japan right at the moment, but we had a very large Japanese position right after the earthquake. I went over to Japan, and it became almost 40% of our assets, so it became very large. And you know, I like investing in Japan. The companies tend to be very well run. You just have to, as you said, you have to be a little bit careful. I don't like the situation so much where there's a huge pile of cash and you say you're not paying very much for the business. I think that's a little bit dangerous because you're assuming there will be some type of change in mentality, and you know, that's not usually a bet I want to make. I was looking for situations where the person was kind of the same thing as we said before in my ABBA criteria. Their interests were aligned. They had shown they were thoughtful about capital allocation.
Yeah, absolutely. And was that position that you're referring to, is that Makita?
Oh, well, we owned a number of them from
Okay.
Makita, Yamaha. They fell more under the Kikkoman. Those three fell, maybe not Makita, but certainly Yamaha and Kikkoman fell under the category of very cheap at the time. We also own Mitsubishi Logistics. They all fell under the category of very cheap, but not a whole bunch of corporate governance excitement. And then at the other side of the spectrum, we owned a couple of companies, which I don't want to mention at the moment because I keep an eye on them, where I thought management was much more focused on shareholders. So I keep an eye on those. I'd love to go back to Japan. It's a great country and it's a great place to invest. But like everything else, I'm a price-focused investor, so I'll wait.
Yeah, absolutely. I think that makes a lot of sense. And can you speak a little bit more about your experience on boards and how useful you think that is to be on a board if you're an investor?
Well, it causes you some difficulties as an investor because well, probably the hardest part of it is you get commitment bias, right? And there's certainly some times where I've been on a board that in retrospect, I would have been better off just to exit the position. And so that was my mistake. As far as a learning curve, I think it's made me a much better investor. I learned a lot through it. So if there's the opportunity for someone to go on a board, I'd highly recommend it. Of course, make sure you're going on with people you like and respect. I've done a couple of activist type board stuff, and you know, as I think Marty Whitman said, I'm a lover, not a fighter, so I prefer not to do that again. But sometimes you have to.
Yeah, I think that makes sense. And you spoke a little bit about earlier about either circle of competence or sort of being on the, I guess, comparative advantage of a transaction in the stock market. Can you speak a little bit about maybe what industries you find that are outside of your circle of competence?
Well, if you had asked me 2 years ago, I would have said oil and gas, right? So I don't like to be the patsy at the table, but sometimes people just get so negative over something where you know, I think you can get up to speed on it as a value investor, as a generalist value investor. You have to be prepared to learn something new. If that's where the opportunity is, then you have to go there. I joke a little bit. I don't know if you've ever gone into your house and you've found a couple ants on your counter. You know, that doesn't mean there are only a couple of ants in your entire house. You know, the second you open your cupboard, you'll find like a million of the things in there. And investing works the same way a little bit. Sometimes you get like in the case of Japan, which you talked about before, or in the case of oil and gas, you get a little bit of dislocation. You go and take a look and you find there's a whole bunch to look at. And in those cases, especially as a generalist value investor, I think you have to roll up your sleeves and try and understand what you're getting in. But within that, as you asked me before on the oil and gas areas, I'm going to stick to my knitting. I'm going to look for you know, margin of safety, assets, people I can trust, and jurisdictions that tend to be relatively friendly.
Yeah, absolutely. I think that makes a lot of sense. And can you speak a little bit about your position in Knight Therapeutics? I think usually pharmaceuticals is interesting because there's a lot of funds who, you know, tend to avoid pharmaceuticals. So can you just speak a little bit about your thesis in that?
Yeah, sure. Jonathan Goodman and Samara, who's the president there, they've done this before, right? This is their second time around. It's not really a development company, so kind of getting back to your oil and gas analogy, we're not doing a development company here. They have really, I guess, two businesses. They have a Canadian business where they basically take someone else's product and get it through the Canadian regulatory environment. And then they have a LATAM business where they're doing something similar, maybe going a step further and handling the distribution of the product, not in the physical sense, but the sales, marketing, etc. So they look to license, in-license primarily. It's a cheap stock. They've been bought back about a lot of stock. One of the things, people got quite excited about it quite early, so the stock ran up a lot, and then a certain amount of disappointment settled in. I found both Samira and Jonathan to be very thoughtful on how they approach stuff, and we're happy to be shareholders. I don't think if you're looking for something to happen tomorrow, I don't think it's going to, but I think it's an interesting company with the wind at its back in LATAM, run by people I like and trust.
Yeah, that makes a lot of sense. And can you speak a little bit, please, about how you look at diversification of portfolio and also about position sizing?
Well, that's a good question. You know, we don't own a lot of stocks. As I said, we have maybe 12 at the moment. I try and have positions between 5 and 10%. They sometimes get over 10%. Probably the mistakes I've made is having illiquid securities in large holdings. So I try and be a little bit more careful over that. But, you know, I think if you find a company that's inexpensive, has a good balance sheet and run by people you like, it seems crazy to put 1% of your portfolio in that, right? So the question is, do you put 5%, 7.5%, or 10%? And that's really more a personal preference. Maybe I don't like to work as much as someone else, so maybe that's why I own fewer securities.
Yeah, absolutely. And can you, I mean, what are your thoughts on how important an MBA is or a CFA is in the investment management industry, and in particular in value investing?
Well, I have my CFA and CPA or CA, of course. You know, I enjoyed doing the CFA program because it was just interesting. Do I use the stuff on a day-to-day basis? No, not at all. So sometimes there are things you have to do if you want to get accredited, so to speak, and I'd certainly put that underneath it. I do think there's more than one path to investing. So you know, a number of my friends have done very untraditional paths to become investors, and you know, that's so I don't think you have to say these are the 5 things I have to do. It's more how you think about stuff, and of course, the more different things you see, the better.
Yeah, absolutely. And can you speak a little bit more, please, about how you analyze management?
That's a toughie, you know. That the problem is, of course, when you meet people, you know, your impressions of them aren't necessarily Spock-like. They're more like Homer Simpson-ish, right? Because you know, you like someone's personality, or you find them easy to talk to, or whatever, and that can tarnish your judgment a little bit. So that's tough. The easiest way to judge someone, of course, is by what they've done before. So in the case of Mike Rose, who runs Tourmaline, or the case of Jonathan Goodman and Samara, who run Knight Therapeutics, you know, they've done it before. This is their second or third time around. So you have track record to look at, and I think that's super important. That gives me a lot of comfort when you can have that.
Yeah, absolutely. And also, can you speak about your thesis for Jefferies Financial, please?
Well, Jefferies, once again, you have to be price focused, right? Jefferies, we watched for a long time and got involved maybe 4 years ago now, in the teens, and it's worked out. You know, it's worked out well. They've been very thoughtful on returning capital to shareholders. It's not as cheap as it used to be. I guess it's around $36 or $37 here, and tangible books maybe 33 and change, although they still have a very large, maybe $6 or $7 of that is their merchant banking assets, which will be liquidated over time. So, you know, I continue to hold it. You know, I don't know what more I can add. Itai, it's well run. It's aggressive. Obviously, it's cyclical, but they have those merchant banking assets that are still to be liquidated.
Yeah, absolutely. And can you talk a little bit about your previous investment in, well, essentially Disney's spinoff of Citadel?
Citadel Broadcasting.
Yes.
That was terrible. It was a disaster. There was too much debt going in. I had assumed they would execute a sale of assets and clean up the balance sheet, but unfortunately, 2008 or 2009, I forget, 2008, must have been 2007. We acquired the position, came in, and I got stuck with my pants down, so to speak. So that's something I won't do again, right? So it was the balance sheet was going to get better, but it was dependent on a sale. I would have been much better off to wait for that sale to happen and pay 20 or 25% more for the stock, but have a significantly less risk. So yeah, don't want to do that again.
Yeah, that makes sense. And can you speak about your past investment in Indigo Books as well?
Well, Indigo is a funny one, right? We got involved when they combined with another company called Chapters. They did a rights issue up here, backed by Jerry Schwartz and Heather Reisman, the two principal shareholders, and I got involved there, and it worked out. It worked out quite well over a number of years. I haven't bought back into the stock, although quantitatively it looks inexpensive. So I guess we bought a little bit, I guess, in 2020, but it wasn't a very big position, so we exited. So I kind of watch with interest. It's the dominant book retailer up here in Canada. It has a lot of cash, although that cash is only shows up really once a year when the inventory turns back, is basically sold post-Christmas. So seasonal business.
Yeah, that makes sense. And can you speak, in addition to the companies we've previously spoken on, can you speak about maybe another company you owned in the past that was successful, and what was your thesis for it? Another company that didn't end up being successful, and what was your thesis for that one?
Oh, well, how much time do you have, right? So there's always been situations. The type of errors that you get, can be you overpay. That's not usually an issue. The problem I've had is primarily around the balance sheets, the quality of the balance sheets, and perhaps hanging on too long after the thesis is played out because I kind of like the people, so I tend to be a lot more careful about that today, being much more focused on the quality of the balance sheet, and also being a little bit more focused on trimming positions as they get larger.
Yeah, I think that makes sense. And can you speak about what are some permanent changes that you see resulting from COVID in the economy?
Well, that's interesting. We'll see if people get back to traveling as much. I think meeting people in person, of course, is always fun. I don't think I really have anything insightful to add on that note. When we look at companies, you obviously think about that a little bit. Probably the more interesting part of that is the impact of technology on a lot of businesses going forward, and certainly that if you had told me 20 years ago, I started my business before we really even had email or really used the internet. I remember getting my first financial statements via FedEx. So there's been a lot of change. So.
Yeah, absolutely. And for a concluding question, what are the most influential events in your investing career?
Well, like this doesn't answer it directly, but the guys who are really smart and really energetic, they become private equity guys, right? The guys who are really smart and kind of lethargic, they become growth guys. The guys who are kind of lethargic and not so smart become value guys. And the guys who are lethargic and really not that bright become deep value guys. And I'm a deep value guy. So that's kind of where I fall in the spectrum of things. So I'm not sure if that exactly answers your question, but no matter what your IQ, you can do well as an investor. Just play to your advantages.
Yeah, that makes a lot of sense. Thank you so much. This is a tremendous session, and we really appreciate you taking the time out of your busy schedule to speak with us today.
Oh, no, my pleasure. Take care.
Excellent. You as well. Bye-bye.
Bye-bye.